Hello friends. Welcome back to Market Geek. What if I told you that you could potentially make money even when the stock market is crashing? For years, only the ultra-wealthy with crores to invest had access to sophisticated funds that could do this. But something exciting has changed in India. SEBI has just introduced a groundbreaking investment product called the Specialized Investment Fund, or SIF, effective from April 2025. And it's creating quite a buzz in the investment community. In this video, you'll discover what exactly is SIF in simple, easy-to-understand terms. The one superpower that SIFs have that regular mutual funds don't. And most importantly, the million-rupee question. Is it the right investment for you? If you're passionate about staying ahead in the world of finance and investments, hit that subscribe button right now and turn on notifications. Let's get started. To understand the power of SIF, we first need to look at what most of us already own: traditional equity mutual funds. These funds are what we call long only. This means they primarily buy stocks, betting the price will go up. When the market goes up, you make money. Great. But here is the problem. What happens when markets are highly volatile, or worse, experience a sustained downturn like we saw in 2008 or during the early COVID phase? Mutual funds have very limited tools to protect or grow your wealth during such times. To access strategies that can profit in falling markets, you had to jump into complex products like portfolio management services, PMS, or alternative investment funds, AIFs. These require very high investment minimums, often 1 crore or more, and critically, come with less tax-favorable structures. So there was this huge gap between the everyday mutual fund investor and the ultra-high net worth individuals. A gap that left many ambitious investors wondering, isn't there something in between? The regulator SEBI recognized this gap and introduced the SIF. So, what exactly is a specialized investment fund? Think of a SIF as a mutual fund on steroids or the pro version of a mutual fund. Here is what makes them special. First, SIFs operate under the same trusted mutual fund framework you're already familiar with. Same regulatory structure, same transparency standards, same investor protection mechanisms. But, and this is crucial, SIFs are allowed to employ sophisticated investment strategies that regular mutual funds simply cannot use. Now, before we go further, let me address the elephant in the room. What is this superpower that SIFs have? What can they do that regular mutual funds cannot? The answer in short is short selling. And I know what you're thinking. What on earth is short selling? Don't worry. I'm about to explain this using a real-life analogy that every Indian can relate to. Imagine it's Diwali season, and you notice that a particular premium brand of decorative lights is selling at 5,000 rupees in the market right now. But you're smart. You know that immediately after Diwali, the demand will crash and these same lights will be available at clearance sales for just 2,000 rupees. Here's what you do. You borrow a box of these lights from your neighbor who bought them for decoration but agrees to lend them to you. You immediately sell them in the market for 5,000 rupees before Diwali when demand is high. Diwali passes. As predicted, the market is flooded with clearance sales. You buy the exact same lights for 2,000 rupees, return them to your neighbor, and pocket 3,000 rupees as profit. You made money by selling something at its peak price and buying it back at its low price without ever actually owning it. That's called short selling in the stock market. SIFs can do exactly this, but with stocks. They can borrow shares from a broker, sell them at today's higher price, wait for the price to fall, buy them back cheaper, return them to the broker, and keep the difference as profit. Now here's the kicker. Regular mutual funds in India cannot do this. They can only make money when stocks go up. But SIFs? They can profit both ways. SIFs are allowed to take what's called unhedged short positions, up to 25% of their portfolio using derivatives. This enables them to run sophisticated long-short strategies, where they simultaneously bet on some stocks to rise and others to fall. This is the superpower I was talking about. This is what bridges the gap between retail mutual funds and institutional-grade hedge fund strategies. Now let's get into the specifics, the rules and regulations that govern SIFs. First, the minimum investment requirement. SEBI has set this at 10 lakh rupees per PAN per AMC. This means if you invest in multiple SIF schemes from the same fund house, your total investment across all their SIF schemes should be at least 10 lakhs. However, there's an important exemption. If you qualify as an accredited investor, meaning you have an annual income of at least 1 crore rupees and a net worth of at least 5 crore rupees with 2.5 crores in financial assets, then your minimum investment drops to just 1 lakh rupees. Good news for systematic investors. SIFs do allow SIP, SWP, and STP, as long as your total commitment meets the minimum threshold. On portfolio construction, SIFs have more flexibility than regular mutual funds, but there are still guardrails. For example, they can invest up to 20% of net asset value in a single AAA-rated debt instrument, and sectoral exposure in debt is capped at 25%. And as we discussed, they can take derivative positions for short selling up to 25% of net assets. Importantly, SIFs are not the Wild West. They're fully regulated by SEBI with the same oversight as mutual funds. They must publish monthly disclosures, maintain transparency, and clearly communicate risks. Speaking of risks, SEBI has introduced a 5-level risk band system, from risk band 1, lowest risk, to risk band 5, highest risk. This makes it easy for you to see at a glance just how risky a particular SIF scheme is. So, why is everyone in the investment community talking about SIFs? Two massive advantages. Advantage number 1. Absolute return potential. Unlike traditional mutual funds that rise and fall with the market, whose performance is measured based on relative returns against a market benchmark, SIFs aim for what's called absolute returns. This means their goal is to make money, regardless of whether the overall market is going up or down. Through long-short strategies, they can profit from both rising stocks they're backing and falling stocks they're shorting. This potentially reduces your dependence on market direction. Whether it's a bull market or bear market, a well-managed SIF has tools to navigate both. Now, advantage number 2, and this is the real masterstroke, tax efficiency. Listen carefully, because this is where SIFs truly shine compared to AIFs and PMS. SIFs are taxed exactly like mutual funds. For equity-oriented SIFs, meaning those with at least 65% equity exposure, you pay just 12.5% on long-term capital gains held over 12 months and 20% on short-term gains. For debt-oriented SIFs, gains are taxed as per your income tax slab, just like debt mutual funds. Compare this to Category 3 AIFs, which also employ long-short strategies. Many AIFs are taxed as business income at rates exceeding 30%, with applicable surcharge and cess taking it to 40% or more. Let me give you a quick example. Suppose both SIF and an AIF deliver 15% returns on a 10 lakh investment. With the SIF, after short-term tax at 20%, your net return would be around 12%. With the AIF taxed at 30% as business income, your net return drops to around 10.5%. That's a significant difference that compounds over time. And this difference is much higher if the fund is held for more than a year, and the long-term capital gains applies. Plus, SIFs enjoy fund-level tax exemption just like mutual funds. This means the fund itself pays no tax before distributing returns to you. Tax is applicable only when you redeem your units and realize gains. This tax advantage alone makes SIFs incredibly attractive for the right type of investor. SEBI hasn't given fund managers a blank check. They have defined specific investment strategies that SIFs can follow, grouped into 3 main categories. First, equity-oriented strategies. These include the Equity Long-Short Fund, which invests at least 80% in equities and can short up to 25%, the Equity X Top 100 Long Short Fund, which focuses on mid and small cap stocks beyond the top 100, and the Sector Rotation Long Short Fund, which dynamically shifts between up to 4 sectors based on market conditions. Next, debt-oriented strategies. The Debt Long Short Fund takes long and short positions in debt securities. The Sectoral Debt Long Short focuses on specific sectors within the debt market. Finally, hybrid strategies. The Hybrid Long Short Fund balances between equity and debt with shorting capability. The Active Asset Allocator Long Short Fund actively moves between asset classes based on opportunities. Here is an important point. To prevent proliferation and maintain clarity, SEBI allows only one strategy per subcategory per AMC. This keeps things simple and prevents fund houses from launching too many similar products. These strategies are sophisticated. They require skilled fund managers who understand market dynamics, derivatives, and risk management. Hence, these institutional-grade strategies are brought to a wider audience with appropriate safeguards. Let's put everything in perspective with a quick comparison with other investment products. Mutual funds versus SIF. Think of it as Standard Edition versus Pro Edition. Mutual funds are accessible to everyone with minimal investment, perfect for retail investors and beginners. SIFs require 10 lakhs and are designed for sophisticated investors who understand higher risk-return dynamics. Comparison with PMS gets interesting. Both target similar audiences, but SIFs have 3 big advantages. Better tax treatment at 12.5% versus slab rate, better liquidity with many strategies offering weekly or bi-weekly redemptions, and a lower entry barrier of 10 lakhs versus 50 lakhs. While comparing against AIF, SIFs offer comparable strategy flexibility, especially with long-short capability. But the taxation advantage is huge. 12.5% long-term capital gains tax versus 30–40% or more for many AIFs. Also, SIFs have better liquidity overall and operate under the more familiar mutual fund framework. One important note on liquidity. While most mutual funds offer daily redemption, SIFs vary. Some equity long-short SIFs offer daily liquidity, while hybrid strategies might offer redemptions twice a week, and debt strategies might be weekly or monthly. This depends on the strategy and is clearly disclosed upfront. The bottom line: SIFs occupy a sweet spot, more sophisticated than mutual funds, more tax-efficient than AIFs, and more accessible than PMS. The SIF market in India is brand new but already showing strong momentum. Quant Mutual Fund made history by becoming the first AMC to launch SIF in September 2025. They received SEBI approval and quickly brought their product to market. Following closely behind, Edelweiss Mutual Fund launched their Altiva SIF platform on 1st October, starting with a hybrid long-short fund. Their strategy allows investors to access sophisticated long-short strategies with the flexibility of equity and debt allocation. SBI Mutual Fund entered the SIF segment under their established Magnum brand, a name many investors already trust from their earlier Magnum schemes. They have appointed dedicated fund managers to lead this specialized vertical. Mirae Asset has branded their SIF platform as Platinum, and ITI Mutual Fund calls theirs Divinity. Notice the trend? Each AMC is creating distinct branding for their SIF offerings, separate from their regular mutual fund schemes, as required by SEBI. Industry experts are optimistic. Many PMS and AIF managers are reportedly exploring mutual fund licenses specifically to enter the SIF space, attracted by the tax efficiency and regulatory clarity. The initial reception has been positive among high-net-worth investors looking for regulated alternatives to unregistered schemes. Looking ahead, we can expect more AMCs to launch SIF platforms, greater strategy diversity, and potentially even more innovative approaches within SEBI's framework. The product is barely 6 months old and has already created this much buzz. Imagine where it could be in 2–3 years. For the right investor, SIFs offer legitimate value, exposure to hedge fund-like strategies, potential for absolute returns regardless of market direction, and favorable taxation under the mutual fund framework. But they're not a magic solution, and they're definitely not for everyone. Now, the most important question: is SIF right for you? If you're a high net worth individual who has already built a strong financial foundation, understands market volatility, and wants to add a tactical, sophisticated element to your portfolio, then SIFs deserve your attention. But if you're still building your core portfolio, learning about basic mutual funds, or don't have 10 lakhs of surplus capital to commit for 3 to 5 years, then stick with regular mutual funds. There's absolutely no shame in that. In fact, it's the smarter choice. SIFs are a specialized tool in your investment toolkit. Use them wisely, if and when the time is right. So, you're now educated about a major new trend in Indian finance. You understand how it works, who it's for, and whether it fits your profile. And that knowledge itself is valuable. Up next, we have done a detailed comparison of SIF with other investment products, namely mutual funds, PMS and AIF. Click on the video link on the screen right now. Before we end, an important disclaimer. This video is purely for educational purposes. It is not an investment advice. Every investor situation is unique. Your risk profile, financial goals, time horizon, and existing portfolio are all different from someone else's. Now, I want to hear from you. What do you think about specialized investment funds? Are they a game changer for Indian investors or just another high-risk product? Do you see yourself investing in SIFs in the future? Let me know in the comments below. I read every single one. If you found this video helpful, please hit that like button. It really helps the YouTube algorithm show this content to more people who need it. And if you haven't already, subscribe to this channel and turn on the notification bell. Thanks for watching, and I'll see you in the next one.